So in part one of the video, we talked about the first three important lessons that we can learn as investors as to why Warren Buffett has become 10 times richer than Carl Icahn, even though Carl Icahn may be even better at picking stocks, even though Carl Icahn is even more involved and more hardworking as an investor. And in this video, we're going to finish this lesson by learning the last two lessons on how you too can become a really, really successful investor, learning from the greatest investors in the world. Now again, even if you only invest in the fundamentally best companies in the world that meet all my investment criteria, it doesn't mean that they all become like an Apple or they'll all become like a Netflix or whatever, right? Shit still can happen. Like Alibaba, fundamentally it's still an okay business, but the bloody share price doesn't go up. At least for now, because of geopolitical tensions. Or Boeing, for example, collapsed 80% because of the plane crash and all that. So shit can happen even though the underlying business is great. But it doesn't matter as long as you have a diversified portfolio that will save your ass. And when you allow your great companies to run into 20, 30 times its returns, that will make up for those stocks where shit happens. And that's the whole idea. Let me give you an example. So let's imagine that you have got, say, $1,000 to invest, all right? You've got $1,000 to invest and you decide to invest into 10 great companies like Nvidia, Apple, Alphabet, whatever, McDonald's, right? Whatever, okay? So let's say, for example, let's choose, let's say you've got 10 companies here that you invest in equally, right? Equally, okay? So you invest, say, hypothetically, theoretically, $100 in each stock. Now, some of you may say, how do I invest $100 into Nvidia when it's like $300, all right? Did you know you can buy fractional shares? Yep, you can buy less than one share through brokers like Interactive Brokers. Yep, you could buy $100 of Nvidia, which is 0.3 of a share, right? You could do that if you want to, right? You could do that, yeah? Okay, so anyway, let's look at the concept behind it, okay? So let's say you buy 10 great companies and you hold it for the long run. Let's say you hold it for 10 years, for example, and you close your eyes, you sit on your ass like Warren Buffett, okay? Now, out of all the 10 companies, will they all become like an Apple where they go up like 12 times? Of course not, right? So let's say out of these 10 companies, you have got 2 of them that become like an Apple, right? Or like a Netflix or like an Nvidia, for example, or like a McDonald's, for example. So it goes up, let's say 12 times, which is what happened to Apple over a 10-year period. So $100, 12 times becomes $1,200, right? Okay, and let's say that happens to 2 of your companies. Okay, and let's say out of the 10 of them, 2 of them, shit happened, and they went to 0, right? So this guy went to 0, this guy went to 0. Now, I've never had a stock go to 0, but it could happen, right? So, I mean, remember, when you buy a stock, the worst that can happen is it goes to 0. It can't go below 0. It can only go to 0, right? That's a great thing, right? But when it goes up, it can go up more than 100%. It can go up 2, 3, 400%. And that makes up for those that go to 0. So, like, I own Alibaba, right? And I don't think so. But even if Alibaba goes to 0, I don't give a shit because my other stocks make so much more that covers the ones that go to 0. Although I don't think it's going to go to 0. So don't panic if you own Alibaba, right? Have faith, it'll come back, right? And let's say that the other 6 stocks, they go up an average of, say, 15% a year, which is the norm for great companies. So that's roughly about 4 times in 10 years, right? So $100 becomes $400, right? This becomes 400, this becomes 400. And again, this is over a 10-year period, which assumes that it grows at, say, 15% annualized return, okay? So again, it's 400, this is 400, this is 400. Right? So again, if you hold a portfolio of 10 great companies, okay, two of them become like an Apple or Nvidia, right? Two of them go to zero, okay? And the rest of them, you get an average of 15% return a year, all right? Now, at the end of the day, how much would you have? Now, remember, your total initial investment was $1,000, right? At the end of 10 years, right, if you add up the total here, you get, say, 400 times 6, that's 2004, plus 2004, that's $4,800 in market value, right? So your $1,000 grew to $4,008 in 10 years. That's about 4.8 times your money, even if two of your stocks, great companies, went to zero. Now, let's be even more extreme. What if 5 of your 10 companies went to zero? Now, that's almost impossible. But let's say this guy went to zero, this guy went to zero, this guy went to zero, right? Half of your stocks all went to zero. But those stocks that did well, you continue holding them. You allow them to compound in value. And let's say it doesn't even go up 12 times. Let's say it only goes up 4 times each, right? And this only becomes $400, this becomes $400, okay? So at the end of 10 years, you have got $400 times 5. That's what? You add this all together, that's $2,000 worth of value, okay? And all this all went to zero. Did you lose money? No, you didn't. You didn't lose money. Your $1,000 of initial investment still grew to $2,000, which is doubling your money. Now, of course, the return really sucks. Doubling your money in 10 years really sucks, but you still made money. You still didn't lose money, all right? So you got to understand that if you buy a group of great companies and you hold them for the long run, it is impossible. It is impossible to lose money collectively. Sure, 1 or 2 or 3 could lose money. They could even go to zero, but the ones that do really, really well will more than offset the ones that don't do well. So making money in the stock market is not about being right all the time. It's about being right more than you're wrong. And when you're right, you make more. When you're wrong, you lose less. And that's how you make money in your investments. Now, of course, in reality, it's virtually impossible for a great business, the stock price to go to zero. It's virtually impossible. But I'm just giving you this example to show you that as investors, we have got such an advantage, right? Because when you invest in a stock, the most you can lose is 100%. That's the most you can lose. But you can make 2, 3, 4, 500%. So you can see that if you hold a portfolio of great businesses for the long run, mathematically, it is impossible to lose money as a portfolio because the gains from your winning stocks will far outweigh the losses from your losing stocks. Now, the problem with most investors today is that they hold a stock for less than 1 year. You can see from this chart that over the years, the holding period of stocks by investors have gone from an average of 7 years holding period to now less than 1 year. And this has come about because of culture, which has been triggered by technology. Now, I remember that when I first started, when I was 17 years old, there was no internet and we could only see the stock price once a day from the local newspaper. And the less you see the price go up and down, the less inclined you are to take action. And in those days, again, you don't get so much news, right? But now what is happening? Almost every time we look at the phone, we look at the app, we can see the price going up and down. We get all these news feeds from all kinds of financial media saying that the recession is coming, the crash is coming, and the market is going to go up, the market is going to go down. So you get all this stimulation from the financial media, like 24/7, you see all the stock prices. So it compels you to take more action, to buy and sell more, which could be great for the stockbroker that's making commissions, but not good for you if you're looking to build your wealth. Now, another reason why Carl Icahn has fallen so far behind Warren Buffett is because he lost a lot of money shorting the market. And what shorting the market means is that he bets when the market's going to fall, he shorts the market using options or futures. And if the market doesn't go down, the market goes up, he loses a lot of money. In a recent article that came out, Carl Icahn admits that he lost $9 billion over the last 6 years shorting the US markets, betting that the markets would collapse didn't collapse, kept going up, and he lost $9 billion. Lesson number 4, shorting the market is not a sustainable way to build your wealth. You see, when you short the market and you bet the market's going to go down, basically you are trying to predict the short-term movement of the market. And yes, once in a while you can get it right. Once in a while you can make a lot of money. So don't get me wrong. You can make a lot of money shorting the market. Jesse Livermore, a legendary trader, made a lot of money shorting the market. We had people like Michael Burry making a lot of money shorting the market. And shorting the market, it appears really cool and really exciting. And that's why you've got shows like The Big Short. You don't have shows like The Big Long, right? Because it's something that seems really interesting. But the reality is that if you study the best investors in the world in the long run, none of them were able to build wealth by shorting the markets. And you find that those that made a lot of money shorting the markets 1 or 2 times eventually lost everything. Okay? A good example is Jesse Livermore. Jesse Livermore is a legendary trader that made a lot of money shorting the market. In 1907, this is a long time ago, he made $1 million in a day shorting the market when the market collapsed. $1 million at a time in 1907 is worth like 37 million equivalent dollars today. In 1929, during the Great Depression, Jesse Livermore again shorted the market collapsed, and he made $100 million in the Great Depression, which is equivalent to about $1.8 billion today, right? So again, he made a lot of money shorting the market, but eventually, when the market, went in the wrong direction, when he bet, he eventually lost everything. He went bankrupt 3 times, and eventually he committed suicide. He killed himself, right? So I learned this lesson myself. Now, in the past, I used to short the market a lot. I used to do a lot of short trades and long trades and stuff like that. And did I make money with shorting? Yes, I did. I made money with shorting, but I found that whatever I made, I would then lose it again. I lose it again. So in the long run, the amount of money I made shorting is very little. And I found that it was exciting doing it. It felt great when I was right. But I found that in the long run, it did not really build my wealth. And so today I do short as well because it's exciting sometimes when I short using options, but I use options, so I've got limited risk. And if I short directly, I've got very tight stop losses. But I do it more for entertainment, honestly speaking, because I realize that the trouble with shorting the market is that you can't get it right all the time. And it's kind of like going to the casino. Once in a while, you can make a lot of money. But if you keep doing it again and again, eventually you tend to lose everything back. Why? Because remember that the stock market is designed to always go up. Right? It's designed to always go up. And statistically, remember, I keep showing this chart that over the last 95 years, right, 22 years, market went down, bearish, right? 73 years, market went up. So the market goes up 76% of the time. The market goes down 23% of the time. So when you're shorting the market, your chance of being right is only 23%, all right? And it's almost impossible to predict when the market will go down. It's impossible to predict 100%. I mean, you can get it right once in a while, but 50-50, right? You get it right half the time, the other time you don't get it right, and whatever you make, you lose it back, all right? And again, if you're only right 23% of the time, in the long run, it just can't build your wealth. And that's why if you study hedge funds, there are some hedge funds that focus on only shorting. And if you study the history, you realize that the majority of hedge funds that are short buyers, majority of them have gone bust. These are called short buyers hedge funds. They all eventually go bust. Now, even though Warren Buffett has admitted many times that there were many stocks that he knew would go down eventually, he would never dare to short them. And the reason why Buffett never shorts a stock, even though he may think it's going to go down, is because he realizes that the risk to reward ratio is not favorable in shorting. Now remember, when you buy a stock, when you go long, the worst that can happen is you lose 100%, right? But you could make 100, 200, 300, 400%. So it is skewed in your favor. But when you short a stock, it's the opposite. If you short a stock, the best that can happen is the stock goes to zero. That's the best. right? So you've got limited reward. It can only go to zero. But if the stock keeps going up, it can go to infinity. The stock can go up 100, 200, 300, 400%. So you are taking unlimited risk for limited reward. And that's why people like Buffett, they never ever short the market, even though they may think it's going to go down, because they know it's just not worth it. One bad short can destroy your entire portfolio. Now, I'm not telling you not to short. You can short. I short myself as well. But do it for entertainment purposes. Do it for the excitement and just short with very little money that you can afford to lose. And when I short a stock, sometimes I short using options so that there's a limited risk. Or if I short with the stock directly, I have a very tight stop loss so that if it goes up instead, I cut my losses and I risk a small percentage of my portfolio. Never short a stock without stop losses, and never short a stock and hold that short for the long term. That's the way that you can blow up your entire account, which is what happened to Carl Icahn and Jesse Livermore. So let me wrap up this whole video. I hope it's been really useful, but let me wrap up this video with the last lesson to learn. Lesson number 5. And lesson number 5 is to follow your own rules. And I can tell you that many of these great investors, when they lose money for one reason, because they broke their own rule. And Buffett does it as well. I do it as well. I sometimes break my own rule, and when I do, then I lose money. I tell my wife to give me one tight slap on the face, right? And what's interesting is that if you read this article about Carl Icahn, he himself said many times that, and this is what he said. He said, I've always told people that nobody who can really pick the market on a short-term or an intermediate-term basis. So I've said this many times before myself, that no one can predict where the stock market is going in the short term with 100% accuracy. No one can predict, Although I'm bullish for the rest of the year, I think the market is going to go up, but I could be wrong. The market could still go down, right? So no one can predict for sure. And that's why for me, whether the market goes up or goes down, I don't really care, because I stick to my investment plan, all right? And I can't say it all the time. But then he made the mistake of not adhering to his own advice, that in the last 6 years, he decided to bet against the market. He decided to short the market, and that's how he lost $9 billion. So he broke his own rule, because his rule was to not predict the market, and he predicted the market and he bet and he lost big time. Even a great investor like Warren Buffett has broken his own rules. For many, many years, Buffett said, never invest in airlines. Airlines are a lousy business. But what happened in 2020? He bought airlines. And then the pandemic hit, he sold airlines at the bottom, lost a lot of money, and it rebounded. So we all make mistakes, so do I. The important thing is to admit your mistakes, learn from your mistakes, and from henceforth, stick to your rules and stick to your area of competence. So I hope this has been a useful, interesting video. Thanks for sticking with me, and be sure to remember to subscribe to this channel for more videos in the future, and do check out piranhaprofits.com for our award-winning investing and trading courses, as well as my Ultimate Investors Playbook subscription, where you get to watch how I invest and trade every single day live. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.